chapter to now going to the balance sheet. And what this is showing you is exactly what we were talking about in chapter 5, and that is dealing with income smoothing, earnings manipulation. I'll get this article posted. I just happen to get the periodical this morning. But notice what they're saying here is that quarterly reports, the quarterly statements, are actually being tweaked a little bit in the sense that they're using what they call non-GAAP earnings. You want to have to use non-GAAP earnings. Well, in there, they have a lot of estimates. So they may change something in the LIFO basis, which normally lowers income, to raise that income. Make certain adjustments on amortization or depreciation. So that tends to be raising earnings, and this is something that's very common. One of the takeaways from the article is that maybe the quarterly reports are putting too much pressure on managers to meet certain earnings levels and expectations, and maybe it makes some sense to eliminate quarterly reporting. In fact, you might have heard current government administration is thinking about eliminating quarterly statements, maybe going to semi-annual reporting. And remember, these are not audited. Okay? Just remember, quarterly statements are not audited, so they're loaded with estimates. I don't think it's going to happen that they're going to eliminate them because it's going to cut a lot of accounting work, because you still have to review those statements. But nonetheless, just to show you that in practice this does happen. So the earnings management is going to be something you will see. All right, so I know we have the exam, and it gave you, I think, enough to look at. The review session on Sunday was targeted for the exam over the first 10 minutes or so. I forgot to turn the recorder on, I'm sorry, so that kind of got cut off, but we got the bulk of that in there. Okay, so let's now go to chapter 6. This is not on the exam, not this one at least, so it's important enough to cover. So we're going to look at the balance sheet and then eventually get to the statement of cash flows. And the major issue in this chapter will be the statement of cash flows. Balance sheet we're going to cover, there's a lot of definitions in there of assets. I'm not going to ask you to memorize, and I'm not going to read off the slides and tell you what an accounts receivable is. I assume you know what that is. I will point out some important definitions. So what we've got in our learning objectives is as we always start with the statements, what are the purposes, the uses, and the disadvantages of a balance sheet. And we'll find out it includes assessments of liquidity, solvency, and financial flexibility. We're going to do an overview of the statements categories, assets, liabilities, and equities. We're also going to talk about the importance of the current, non-current classification, and then tie that into the operating cycle. We'll do some ratios, which you'll find, I think, will be very useful in assessing liquidity. So the primary advantages of a balance sheet is from a predictability standpoint, is to look at the resources that the company has available to generate future cash flows, as well as the obligation it has to pay that will use up those cash flows. So you're trying to project the company's ability to use these resources to create income and cash flow. We're also going to talk about short-term liquidity. Short-term liquidity is needed to pay off its current obligations, and when you look at short-term liquidity, you might want to know first, what do we mean by liquidity itself? And if you had to define it, I think the best way to look at liquidity is the ability to convert an asset into cash with minimal risk of loss. So if you say an asset has liquidity, or if it's a liquid asset, it means that it can be converted into cash quickly with minimal risk of loss. Solvency is more of a long-term issue with respect to long-term debt. And also, it does provide you, if you're able to determine cash generated in the future, current liquidity, long-term solvency, you're also assessing the company's financial flexibility. And what do we mean by financial flexibility? Well, what's your financial flexibility? How much could you borrow? And if you do borrow, how much additional debt can you take on? If you lease a car, is it debt? Similar. So if you're leasing a car, you may not be able to buy something else on a long-term credit arrangement. So that's your financial flexibility. Do you have the ability to make payments? Do you have the ability to pay dividends? Changing your financing or financial structure. So those are the advantages of the balance sheet. Disadvantages, well, we know that the limitations here is that we don't portray the market values. And, going concern typically does not use market values, although there are changes, as you know, in US GAAP. And IFRS, we'll talk about that later, will have more fair value accounting. And other resources that are not recorded and certain obligations that are not recorded on the balance sheet, for example, the value of your workforce, the value of your training programs, the value of your research and development. So for example, if you work for a company that invests substantial amounts in training programs, that is expense, it's not an asset. But it really is, in a way, an investment. When a company expends millions of dollars on research to develop new products, we expense that. It hits net income, it doesn't show up on the balance sheet as an asset. So human capital, research, all types of other investments that the company may make will not be there. In addition, certain liabilities that you may have and obligations that you may have are not going to show up if they are what we would call contingent. So some liabilities that may result will be only a liability if something else happens. So for example, you may sign an agreement where you promise to buy inventory from a developer, a company that's going to develop a new product for you, but if the product's not developed, you don't have a liability. But we have to tell the reader of the financial statements in the footnote that in fact there is a potential obligation. So if this supplier manufactures that product, you must buy it. And therefore you could be obligated for a certain amount of money to be paid out in the future. Those are contingent liabilities. Other contingent liabilities would be what? Litigation, lawsuits, antitrust violations, certain penalties that could be imposed if you lose the case. So we can't book those yet, and those are not recorded as well. So lots of stuff is, lots of material and information could be removed from the balance sheet. Now, I'm not going to go through the fair value hierarchy again, we already did that, but market values are getting to be a little bit more acceptable because we now have better disclosures in terms of the reliability of the inputs into that process. So we said we will disclose inputs, for example, in this hierarchy. So what's most reliable would be a quoted market price. In the middle, you've got market comparables. In the third, the least reliable would be the management's estimates that are used. So we've already looked at this, but this is why fair value has become more acceptable, is because we're making disclosures that enable the user to understand the potential risk of those fair value measures. And as I said, from the standpoint of objectivity or the standpoint of what faithful representation, you would think that a market quote at the end of today at 4:30 when the market closes, that quote is just as good as historical cost. Because it's a traded security, for example, or a valuation that is objectively determined. And it's neutral, it's free from error, and so on, so it's got faithful representation. So that's why we move more toward fair value accounting for those types of assets. Now, what about the classifications on the balance sheet? And again, we're just going to review some of the things here. We'll get in and slow up, get to some detailed discussions in just a few minutes. But we know that the major categories are assets, liabilities, and equities. We also know that you could have current and non-current classifications. The definitions that you see here, and by the way, we should add, I'm just going to remind you there's something here you have to add. Owner's equity includes capital stock, additional paid in capital, and don't forget the accumulated other comprehensive income. So that's something you have to add to that. And the definitions, you see below that, definition of assets, definition of liabilities, and equity. You need to know that, of course, for the exam, because that's part of concept statement number 6, the elements of financial statements. So this is included within the elements of financial statements. If you remember, we saw that back in chapters 1 and 2. So that's part of the elements of the financial statements. We're not going to ask you to memorize this, but you should know the essential characteristics of an asset. So again, it's a future economic benefit. Notice that it's obtained. Could be owned or controlled. You don't have to own an asset to have it on your balance sheet, correct? If you lease an asset, it goes on your balance sheet. As long as you control the asset's economic benefits, it's an asset on your balance sheet, even if you don't own it. So if you have the right to use an asset, it is controlled and it is an asset on the balance sheet. Liabilities are probable future sacrifices of economic benefits from obligations that you have right now that resulted from some type of past transaction. And equity, of course, is the residual interest, and we sometimes call those net assets. I remember someone had a question on the diagnostic exam about this. Net assets are assets minus liabilities, because these are the assets that remain after the senior claims of creditors are satisfied. So the creditors have first claim to the assets, and then what's left over is the residual claim to those assets. All right, now, here's something that's very important. One of the things you may not have thought about, and we'll do more of this in a bit, but why do we have a current, non-current classification? Well, you see the term here, we're trying to match maturities, and the whole idea of the balance sheet, let me put this on the board in a little bit different way. What you would see is if you look at the balance sheet, what's the purpose of the classification? Well, the purpose of the classification is what I said, to match maturities. When you look at the classification, you may say, well, I have to do it because that's what I need to do for accounting. But how does somebody use this? Why is somebody concerned about the level of current assets? Primary reason? Will those current assets be sufficient to pay off current liabilities? That's the main purpose of that classification. You got to try to match the maturities here of current assets with the current liabilities. Now, you don't have to copy this down. We have this definition later. The current assets are expected to be converted into cash within a year, or operating cycle, whichever is longer. And those liabilities are expected to be due within a year or operating cycle. So you have to make sure you have enough cash, enough liquidity, enough liquid assets to pay off those liabilities when they become due. And that is short-term liquidity. And then on the other hand, you won't have to worry too much down here, but you do look at the non-current assets. You don't expect these assets to be converted into cash within a year operating cycle, but that's okay because you also have liabilities that are going to be converted or due and payable at some point longer than a year or operating cycle. Right, so that's what we mean by matching maturities. Now, on the equity side, we said contributed capital, retained earnings, other comprehensive income. I just repeated that so I can go back to it. Non-controlling interest, sometimes called a minority interest, and that again represents the outside shareholder claims to company. What this means is that if you have a subsidiary and you only own 90%, 10% becomes the non-controlling interest. So you've got a parent company and that is owned 100% by, let's call this company P, shareholders. Let's say you've got a subsidiary that is 90% owned. So that means that 90% belongs to company P, and the other 10% is the non-controlling interest. This company has shareholders. Sometimes called a minority interest. I know we've seen some of this before when we're looking at some of the actual financial statements. So if you have a company that owns 90% of company P, the other 10% is the non-controlling interest, and that goes into stockholders' equity. We'll go into stockholders' equity. Now, question for you. Anyone know if you own 90% of, this should be company S, I'm sorry, 90% of company S. If you own 90% of that sub, how much of its assets do you take in on your balance sheet? What do you report on your balance sheet when you consolidate? Does anyone know or have an idea what you would take? Take 90 or you take 100? Take 100%. So the problem here is, just to try to make this a little bit more lucid, is that, let's say you got a company S, let's say it's got assets of 1,000, liabilities of 200, and stockholders' equity of 800. When you combine them in consolidation, take 1,000, 200, but how much equity of that sub do you hold? 90%, so 720. So in order for the balance sheet to balance, you have to have 10% down here in equity as the non-controlling interest. So stockholders' equity stays at 1,000, but it's split between the majority shareholder and the non-controlling interest. That's how it happens. So it's part of stockholders' equity. And as I said, what I'm doing today is I'm going through the balance sheet, but I'm going to make sure I hit items that I'm fairly certain you haven't seen before. And I know we covered that a little bit, but not sufficient. So that's what we mean by a non-controlling interest. The non-controlling interest is simply part of stockholders' equity in consolidation for the portion of the company that you do not own in total. Yeah, Mark?
For the 86 vice versa, if you control like 10%, then it will be the minority interest.
Yeah, good question. If you only control 10%, you can't consolidate. Normally, you can't consolidate. There are some exceptions. And if you don't consolidate, it means that you would have an investment. Just like if you went out and bought 10% of the company, it would be an investment in your portfolio. So it becomes an investment asset. It does not become a controlling interest. It does not become a subsidiary. Over 50 typically. Yeah, there are exceptions now. I mean, recently we've been bringing more and more companies on the balance sheet. But typically, if you only own, let's say this 10% was owned by a single company, on their balance sheet they would have an investment account. All right, so that is the purpose of these classifications, at least current and non-current, which we will get to. All right. Any other questions? Then let's do some information. I'll give you some information about the current asset section of the balance sheet. I wanted to define something here. Yeah, sorry. Sure.
Even if you're using 90% of the asset, you don't own it, does that increase your capital?
So if you say if the parent company owns less than 90 or it owns
No, like you had a company P, company S, right?
Right.
So company S owns 90%.
Oh, company P owns 90% of that, of the sub. Parent company has 90% of the, so here, what this means is that company P owns 90% of the subsidiary. So the other 10% becomes the non-controlling interest or the minority interest. So if you own 90% of the company and I own 10, you would be able to consolidate that company's subsidiary or company S to your balance sheet. I would not. That's getting back to Lawrence's question.
So, and you said you record in your balance sheet?
I record on my balance sheet as an investment, but you would record this as a subsidiary, because you have 90, and you have a controlling interest in that company. But on your balance sheet, you have to give recognition to the fact that somewhere there is equity that is not part of the company P or the parent company's equity. And that's why it sits in stockholders' equity.
Okay, so if you don't own that, then it would increase your equity.
Your equity in the sub is limited to 90%. But we have to show where that other, because don't forget the example I gave you before, if you have 100% of the company's assets, but you don't own 100%, you only own 90, somebody else has equity in that. And that's the outside interest or the non-controlling interest. Or minority interest, sometimes called. So if you ever see, you will see questions on this. I mean, I've seen some of them on the CPA exam. Just need to be sure you understand that that is in stockholders' equity. It's part of stockholders' equity. And what it represents is the portion of the stock of the subsidiary that you do not own. And you'll see that over and over again in all the examples that you see in the textbook or the balance sheets we're going to look at. I'll get back to that again in a bit. All right, so now, definition. Current assets. What are current assets? Current assets are cash and other economic resources that will be converted to cash within 1 year or operating cycle, whichever is longer. So what's the operating cycle? Anybody know? Anybody know what an operating cycle is? Yeah, Chris.
Just how long it takes to produce this value product? Or?
Yeah, it's just essentially a cash-to-cash cycle. So let me just put this. This is in the notes, but I'm just going to put this up here for now, just so we understand what the cycle is. Cycle is, again, for a brick and mortar company. I've got this later on. Don't worry about it. We'll get to it. But just to tell you what a cycle is, let's say you start a business with cash and you'll raise some credit. You buy inventory, you sell the inventory, you have a receivable, and then you collect it. What do you do with the cash? The first thing you do is you pay off the liabilities. The next thing, you might put that into investment securities. If you have excess cash, notice that if you need the cash, you can put it back in the cycle again if you have to sell it. And the third thing you do is put cash back in the cycle. Now, how many operating cycles do you think a company has per year? Is it less than one, more than one? Typically, it's more than one. Companies are running cycles like this probably 3, 4, 5, 6 times a year, depending on how fast they can move. Notice it's a brick and mortar type company. It's not a service company. Well, maybe not a brick and mortar. It could also be an online company, but there's no, it's not a service entity. So the idea is the definition of a current asset is cash or other assets that will be converted to cash within 1 year operating cycle, whichever is longer. Normally, the operating cycle is less than a year because you have more than one per year. Is it possible to have an operating cycle greater than a year? Yeah. There are some businesses like shipbuilding, companies that are manufacturing aircraft, certain construction projects that go on greater than a year. Typically, lots of stuff that's not good for us, like alcohol and tobacco, has an operating cycle more than 1 year. So if you looked at a tobacco company's balance sheet, you're going to see inventory as a current asset. When you read the footnote's going to say, we are holding leaf tobacco in inventory that we're not going to be using for another 20 months or another 24 months. 2 years it might take to hold that inventory and have it ready for production. But that's the operating cycle. So even though you see current, you can't expect it to be a year every time unequivocally. Yeah, normally, if you said it's a year, you're safe. But I just want to make sure you know that depending on industries, and when you get out there into the field, you're going to see lots of different industries. Certain industries have an operating cycle greater than a year, and it still could be current. So an operating cycle greater than a year could still be a current asset. So inventory that you're not going to use for 18 months could still be your current asset. All right, so that's the operating cycle. We're going to get back to it, and we're going to show you how to measure that cycle by using certain financial ratios. All right, now, let me just go through some of these with you. As I said, I'm not going to read and ask you to memorize what an accounts receivable is, but getting ready for the cash flow statement later on in this chapter, you've got to look at what a cash equivalent is. So we know that cash and cash equivalents would include coins, currency, and so on, but what is a cash equivalent? Cash equivalents are short-term, highly liquid investments with original maturities of 3 months or less. What that means, on the day you buy the security, it's got 90 days or less to maturity. So you're only going to hold it a maximum of 90 days. Now, why is that cash? It's an investment. Why are we calling it a cash equivalent? Because you can't be holding it for long-term interest income, right? Because it's going to mature in 90 days. So the purpose of holding it is temporary cash needs. So it's a temporary holding. So for example, a treasury bill, right? You have excess cash in the operating cycle, for example, and you know you're going to need that cash very soon, so you buy something that is close to maturity. Or you've got commercial paper, which is essentially receivables from corporations that are sold by commercial banks and money market funds. So if it falls into this category, it is a cash equivalent. So just remember, cash equivalents have maturities of 3 months or less on the day you buy them. That makes them a substitute for cash. They're as good as cash because you're not going to hold them for long-term interest and dividend income. Now, non-current assets. Well, these are assets we expect to be converted to cash, sold, or consumed within 1 year, in more than 1 year or operating cycle, whichever is longer. So those would include long-term investments, property, plant, and equipment, and so on. But what I wanted to do is make sure you're clear on investments. Certain land would be considered an investment and not an asset, not a property, plant, and equipment. So land may not necessarily be part of property, plant, and equipment. If land is held for speculation, if land is held for resale, it may be included in investments. It can also be included in other assets as well. So I'm just giving you the exceptions. The other items up here I know you've seen. So land held for speculation. If you're buying land and you want to sell it, it becomes an investment. And another interesting point is, you talk about these cryptocurrencies today, Bitcoin and things like that. No one really knows where they go on the balance sheet. Some companies report them as intangible assets, some report them as investments, some report them as inventory. So no one really knows how to categorize those. So you might see some of those in investments, but the FASB has not given any kind of guidance on that yet. But land, which you would think of, and what I'm trying to do is just point out some of the important issues, land that you would think would be property, plant, and equipment is not always PPE. Not always PPE. What goes into property, plant, and equipment is, and we'll see this later on in the semester, in order to be in property, plant, and equipment, it has to have 3 characteristics. It has to, of course, be tangible, long-lived, but the most important characteristic is that it has to be used in production. If the asset is not being used in production, it is not part of property, plant, and equipment. So if you have an example, a question that says that land or building or a piece of machinery is idle, it's not being used in production, it may not be included in property, plant, and equipment. So they have to be used in operations. This is the key. It's got to be used in operations, and they have to be for revenue generating purposes. If you're holding an asset for resale, it's not in property, plant, and equipment. So perfect example, discontinued operations. Remember, we pull those assets out of their categories because they're not being used for those purposes anymore. They're being held for sale. So when assets are held for sale, you might find them in other assets as well as investments. So when assets are held for disposal, they could fall into this category. Yeah, Tom?
So what would you put in their item?
I'm sorry?
What would you put in their item?
Idle plant would probably, as we said, they would go into probably other assets. It depends on, it actually, as we'll see, it depends on the length of time you expect it to be idle. So for example, you could have a auto manufacturing plant that they shut down during certain times of the year, and that will happen. So if you know someone that's in that industry, they will tell you that in certain cases when business starts getting slow, they might shut, if they have excess inventory of, let's say, pickup trucks. The factory that manufactures those trucks may be shut down for 6 months. It'll say in property, plant, and equipment if it's shut down temporarily. We'd have to disclose that if it's a temporary shutdown. But if we expect the shutdown to be very long term, and in fact maybe permanent, you have to take it out of property, plant. Okay, so property, plant, and equipment should only include assets that are going to be productive. Idle plant, that's going to be idle for an extended period. Plant assets that are going to be held for sale would probably be categorized as other assets. All right, liabilities. We know they're probable future sacrifices from present obligations that result from past transactions. Could be classified as current or non-current, as we said. Critical definition here. What is a current liability? Liability is expected to be paid within 1 year operating cycle, whichever is longer, which you would think, but here's the most important piece of this. They have to be paid out of. They have to be paid out of current assets or create other current liabilities. So, in other words, in order for the assets to be current, on the liability to be current rather, it's got to be paid out of current assets. So for an asset, for a liability that you expect to be paid out within 1 year operating cycle, it's got to be paid out of current assets. Sometimes it may not be the case. So for example, you know about accounts payable and wages payable, you should know that. What about this last one? Current maturities of long-term debt. So let's take a look at that. So let's say you've got a long-term note payable. Notes payable, $100,000, with $10,000 due each year. What would you do on that balance sheet? Is the balance sheet properly classified at this point? Would you leave that as long-term? Well, let's look at the definition. Is it going to use up current assets within a year? Or operating cycle, whichever is long. Not all of it, but 10,000. So what you would need to do is reclassify $10,000. And that would be what they call the current portion of long-term debt. That's the current portion of long-term debt. Now, it's possible that this $10,000 could be paid out of a fund, which we'll talk about in a second. But if the payment is going to come out of a current asset or created on the current liability, it is going to be current. So to be current, not only does it have to be due and payable within 1 year operating cycle, it's got to use up current assets or create other current liabilities. I'll show you that exception in a minute. Yeah, one second. Yep. Yep. Mm-hmm. Now the interest could go into interest payable, and that could be added. So current maturities of long-term debt will use up current assets typically. They'll be due and payable within a year of operating cycle. All right, now there's one other one for you, which is going to be, unless there are any other questions on this. What if in non-current assets I've got a special debt payment fund? And sometimes an example would be something called a bond sinking fund. This will depend on the company's credit rating. So it's something you probably will see in practice depending on the nature of your client's credit rating. If your client's credit rating is not the best, if they borrow, the bank may say you must have a fund of assets available to pay off this debt. And that will include investments, doesn't have to be all cash. They could be holding long-term investments in there as well. Now, if $10,000 is due each year, and I'm paying it out of a fund, would you still make that classification? So again, due each year. So it meets one part of the liability definition. It is a liability that will be due and payable within 1 year operating cycle, whichever is longer. However, is it using current assets in its liquidation? No. So if I'm paying out if this is going to be paid out of that fund, it stays as non-current. So it doesn't matter whether it's due within a year. The point is it using current assets or creating another current liability? So that's an illustration of the fact that in order to have a current liability, it has to use up current assets or create other current liabilities. Typically, the current maturities of long-term debt are going to be current. However, they could be paid out of special funds. If those funds are not current, then the liability stays as long-term. And again, the reason, this is not something to kind of memorize, it's something to understand. And the understanding is you're trying to match maturities. If this is becoming due every year and it's not going to drain current assets, it's not a current liability. So you match the maturities. This loan is paid out of a non-current asset, so you're matching the maturity. If it was payable out of current assets, it would be put into the current liability category. So it's not only the time period, it is the nature of the payment that's going to drive the classification. And on top of that, go back to the asset, the same thing. Got to look at the operating cycle as well. Right? So if the operating cycle is greater than a year, you could have an asset as current that you're not going to use for 18 months. So the point of this discussion is to make sure you're aware that current does not necessarily mean 1 year. Non-current does not necessarily mean more than 1 year. It's going to depend on circumstances, depends on industries, and depends on specific types of assets and liabilities. All right, now, before we go on to any other categories, questions on that list. So you have to look at the nature of the assets that will be used to pay off the liabilities. That's the most important piece. Yeah, Lawrence.
Competing plans are held for resale. You said that it would be other assets.
Other assets, land for resale could be, it depends if you bought it for speculation, it could be an investment. But if I have any other plant assets or buildings that I'm holding to sell, they're not being used in production, they would be in other assets.
Why do you have like the security for resale?
The security for resale, it'll stay in investments. Yeah, because the purpose of buying securities is to sell them, or to earn income and then sell them. When you buy a plant, the purpose is not to sell, it's to be used to generate revenue. But the other extension of that question is when you have a debt security, you could be holding it for interest income purposes. And therefore, if you intend not to sell it, if it's held to maturity, then you don't have to worry about fair values because you're not going to sell it. So it does have, your question does have some implications. The other part of it too is if the debt was available for sale, it would be measured at fair value, but those unrealized gains and losses, which I'll explain in a minute, would go into other comprehensive income, which I'll show you. But it's a good question. All right, any others? All right, now, long-term liabilities, as you would expect, obligations not expected to be paid within 1 year operating cycle, whichever is longer, and you don't expect them to use up current assets or create current liabilities in their liquidation. So examples here would be mostly long-term debt, capital lease obligations, and various pension obligations. And as we said before, a current maturity of long-term debt not expected to be paid out of current assets. And then finally, just stockholders' equity, a couple things to say in here. What I want to be sure is that, again, this is something we talked about lots of times for the exam, and this is going to add this because this is now have to be very specific. These have to be debt investments. Accumulated other comprehensive income on the balance sheet in stockholders' equity will include unrealized gains and losses on debt investment securities held as available for sale. If they were held for trading, it would be different. Someone asked that question, I think, during a review or some other time, and I'm going to explain it here because I think it was a real good one. Then various pension benefits and foreign currency translation. So these are the three items that we've already, this is part of Chapter 5 as well. These are the three items that go into other comprehensive income. Fair value, markups or markdowns on debt investments that are held as available for sale, not current trading, unrealized pension benefits, and also translation gains and losses. Now, we've already gone through this, I know I said it, but now I'm going to formalize it here. These are the reasons why these unrealized gains and losses do not go into income. We mentioned this, I think it was one of the last things we said on Thursday. The reason why you don't put these into income is first, there's a low probability of short-term cash flow. So in other words, you don't expect to sell, and that's why going back to your question, you don't expect to sell an available for sale security. If it was trading, if I told you those debt securities were trading, and I know you had a homework question on this, when we talked about the trading investments. Trading investments are sold every single day, so that the probability that the cash will be realized is very high. Therefore, you put that into income. So notice the difference. If I've got the same security and one is held for trading, the other is held as available for sale, the available for sale security If it's marked to market, that gain or loss stays into other comprehensive income. It does not go into the income statement, because the income statement should only reflect those items that we expect to realize in cash in the near term. The other reason for it is that these were always thought as transitory components of income, and therefore it reduces earnings volatility. If you remember the last thing we did on Thursday, when we looked at other comprehensive income on a comprehensive income statement, we saw the volatility of, for example, the foreign currency translation. So in one year, there could have been a $33 million gain. The next year, it's a $66 million loss. That volatility is something you want to avoid in net income. And the other reason is that these are probably not part of normal operations. So if you remember, we was answering your question again, talked about holding investments. Unless you're a financial service company, these investments are peripheral activities to your normal operations. So it's unlike your plant and equipment. So think about, and this is what makes this curriculum, and every college is the same curriculum. We don't really focus on financial service companies. But if we did, and if you can kind of stretch your imagination a little bit, investments, securities, Bitcoin, cryptocurrencies, or really, or any other type of financial asset or liability becomes the planned assets, if you will, for financial service companies. These are the revenue drivers for that company. Whereas a brick and mortar type company, their drivers are plant and equipment. So it'll be a completely different setup if you looked at a financial service company. As I said, you will learn, if you go into financial services, most of that training is going to be done in-house. So you'll learn a little bit more about that. Right, so again, these are the reasons, and these are the types of items that you're going to find in other comprehensive income. Now again, it's interesting. You take the same item. So take foreign currency. What if the foreign currency was not a translation, but was a transaction? What if I needed to buy foreign currency to pay a supplier, let's say in Europe? I had to go buy euros. I had to invest in euros. And while I'm holding the euros, or let's say I have a contract to buy them, while I have that contract, or holding the contract, or even holding the foreign currency, it fluctuates in value. Does that go on the income statement? Yes. Why? Because as soon as the invoice is due, I'm going to have to make that payment. And I'm going to have to either have the currency or buy it. So that's a transaction. It's not translation. The difference, high probability of cash realization. I'm buying the currency because of what? It's part of my operations if I'm buying and selling in another country and I need that currency. So the differences are whether or not it's going to be realized in cash in the short term, whether or not it's part of your normal operations, and whether or not it is a permanent or a transitory component. Now remember, buying currency for inventory transactions is a permanent component of income. Permanent component. All right. Anything else on comprehensive income? I know that's something from chapter 5. All right. And just remember, we did this on Thursday. We've got 2 ways to report comprehensive income, either 2 separate statements, a statement of net income and a statement of comprehensive income, or you could append the comprehensive income to the income statement, right below net income. We also closed on Thursday with a look at, I think it was Johnson & Johnson's stockholders' equity statement. Just remember that the very last thing we looked at in chapter 5 was that the comprehensive income is also shown on the statement of stockholders' equity, a separate column that reconciles it as well. All right, and then finally, you should know about, we know what retained earnings is, and you should be aware of treasury stock, that it is the company's own stock that they buy back. They hold it for a certain reason, maybe to sell to employees and employee stock option plans, or use them in mergers and acquisitions. Treasury stock, by the way, is not active. It can't vote. It doesn't receive dividends, and we'll see that next semester. We're covering accounting for treasury stock. All right, so that is a sort of a top-side overview of some of those items, but please take careful note of the items that I've emphasized, because those are the ones that I know you haven't seen before, haven't spent much time on before. I mean, the fact of knowing what a receivable is, I think you know that already. Now, operating cycle, let's go back to that. So here's the cash operating cycle, and this is a critical concept in financial analysis, and the reason why I'm emphasizing it here, what I want to show you is why the classifications of current and non-current are so important. How do we use the balance sheet classifications to assess liquidity? How do we use the balance sheet classifications to understand if companies need short-term financing? And I'm going to give you an example now. So let's take a look at this my nuts and bolts company, and what I'm giving you is just a sample of, illustration. But here's a balance sheet, and it is at December 31st of 2018, 2017. And you should note that balance sheets, you always get 2 years comparative. Income statement would be 3. I also want you to note that the balance sheet is at a point in time. These are point in time elements, so that's important for the conceptual framework. The income statement we'll look at in a second. I'm only going to give you 1 year, but that's over a period of time. Current assets, we've got cash, receivables, net of the allowance for bad debts, which we'll cover next in Chapter 9, and then inventory. And then we've got property, plant, and equipment, net of accumulated depreciation. So those are your total assets. Then when we look further, you're going to see that we have accounts payable, long-term debt, and then in stockholders' equity, you only have common stock. Maybe that's no par stock, for example. I don't see any contributed capital in excess of par, and then their retained earnings. There's no other comprehensive income here, trying to keep it as simple as possible. Now, we move to the income statement on the next page. And this is a flow statement. It's for the year ending. And you typically get 3-year comparative on an income statement in the United States. And I've got your sales, cost of goods sold, gross profit. You got your operating expenses, and EBIT, which is your earnings before interest and taxes. That is a pure operating income less interest expense, would give me pre-tax income. Now, I just wanted to say one thing. I think this still, I'm not sure, I know you mentioned it Sunday, that is operating income. There could be below that line not only other revenues and expenses, but there could be gains and losses on sales of plant assets, losses on the strike of employees that you saw in the homework. There could be all other items in here that would then bring you to income from continuing operations. So does anyone still have any difficulty understanding the difference between operating income and income from continuing operations? Operating income is pure EBIT if it's defined properly by the entity that's reporting. Revenues, cost of goods sold, operating expenses. Below that, you could have unusual and or infrequent items. You could have interest income, interest expense. That would lead you to income from continuing operations. And then below that, you would get what? Discontinued if you had it. So I don't want you to be confused between operating income and income from continuing operations. In this case, this happens to be income from continuing operations. I don't have any discontinued in this example. All right. Now, we're going to use the statements to calculate some key ratios that we're going to build off of the classifications. Now, in this textbook, these ratios are found at the end of certain chapters. I'm going to pull together a few of them here. This is the current or the so-called working capital ratio. You can see this in finance as well, but I want to use it here in order to illustrate the importance of the classifications. So the current or pure working capital ratio is simply the ratio of current assets over current liabilities. Now, you also get the term working capital. Rather than having it in ratio form, you sometimes see this simply current assets minus current liabilities. But in ratio form, it does, again, match maturities. It's showing you the resources available to liquidate liabilities that come due at the same time. So it's the idea of matching maturities. When we look at these ratios, what you're going to find out, in order to interpret them, you've got to know the industry and the company's trend. You can't take these in isolation. And on top of that, this ratio has always been seen to be a very good predictor of financial distress. So that if we take a look at a nuts and bolts company, I'm going to go back to the statements in a second. Current assets are total current assets. Let me bring this down a little bit. Total current assets for our company is 800. Total current liabilities are 4 in 2018. In 2017, 550 as the current assets. Current liabilities are 5. So the ratios then will be calculated right from the balance sheet with no adjustment. So in 2018, the ratio was 2 to 1, and in 2017, it's 1.1 to 1. It is improving. The higher this ratio, the better the company's liquidity position is. Right? More current assets, more of a safe or a safer position to pay off those current liabilities. Now, I'm not going to do much with this now. When we get to the cash flow statement, we're going to differentiate between pure working capital and non-cash working capital. Non-cash working capital is typically assets other than cash and investments. We can talk about that when we get to the cash flow statement. Now, sometimes companies tend to look at the working capital ratio as too optimistic because not all of the current assets could be converted into cash quickly. So, for example, when we look at let's look at this company's current assets. What would be the most likely asset to give you the hardest time to generate cash out there? No, it's current only. Which one? Well, cash is cash. Accounts receivable, you could probably sell them because there are people that buy receivables. Inventory. So inventory is not very quick, as we say. You don't turn it over quickly. Prepaid expenses. What if you prepaid insurance? Prepaid rent. You can't really market that. So we sometimes have a ratio that we call the quick ratio, which takes out assets that we do not expect to convert into cash quickly. So that in this example, this is just one measure of it. It's cash, securities, and accounts receivable divided by current liabilities. In this case, we don't have securities, so our quick assets are only going to be cash and accounts receivable. So that when we adjust the current ratio to the quick ratio, you'll find out if we just took cash and receivables for the both years divided by the current liabilities, the ratios become much more conservative. So the quick ratio is more conservative. It drops from 2 to 1 working capital to quick ratio of 1.125. So it becomes much more conservative. And again, it's going to depend. Quite frankly, it's possible that inventory, depending on what you have, could be very liquid. And in some cases, the inventory could be more saleable than the receivables. Just depends. So once again, this is not a blanket definition, but it could change depending on the company. So that's the working capital. Now, the most important piece of this for us and for this course is measuring the operating cycle. So we can measure. So what I'm going to tell you is that what we're going to do is we're going to measure the operating cycle, and we're going, you can do this for any corporation, we're going to find out how long it takes the company to sell its inventory, on average. We're then going to determine, on average, how long it takes to collect it, and then how much time do I have to pay back. And that's going to assess the company's liquidity. In other words, if I have to wait too long for cash relative to what I have to pay back. So for example, what if it takes me 75 days to go from inventory to cash? And my suppliers want cash in 30 days. What do you have to do? You're going to borrow on a short-term line of credit. And in many cases, you'll find that banks have asset-based lending. What do they mean by asset-based lending? It's almost like a line of credit that you could get, or you've heard of home equity lines of credit. Some people you may know have a line of credit, and they do it through their bank, and they use their house as collateral. You could do the same thing in a company, but what's the collateral here? The asset-based lending uses inventory and receivables as the collateral for those loans. And it's a revolving, they call them a revolver. It's a revolving line of credit that you could draw on, just like a home equity loan. You could draw on that, pay it off without any restrictions. So in this case, let's take a look at the key ratios in measuring the operating cycle. All right, the first one is the accounts receivable turnover ratio. Accounts receivable turnover is an average. It measures how many times per year the company goes from its full receivable balance to complete collections. It's the ratio of net credit sales to average accounts receivable. What do we mean by average accounts receivable? The average accounts receivable takes the beginning plus the ending, and we divide that by 2. And almost all ratios will have averages in the denominator of the fraction. Now, can anyone think why I want averages in there? Why do I want to use the average balance? Why don't I just use the ending balance? Or maybe the beginning. Which one is better?
Because the number's going to fluctuate from month to month.
Yeah, it's the flow. It's the issue that these numbers are flowing over time. So here's the way you have to look at it. When you look at this ratio, sales is sales a static number, a point in time, or is it over a period? Is it a flow? It's a flow. What about accounts receivable? Is it a point in time element, a static number, or is it a flow? No, it's a point in time element. So the problem is it's an apples to apples ratio. So as you were saying, receivables, obviously the balance will change all the time. And therefore to convert, in a sense, make it like more like a flow, I take the average. The average is there to make it more like a flow variable. The other problem is, which one would you pick? Beginning or ending balance? If you didn't use an average, what would you pick? The beginning or the ending balance? I don't know, maybe I'll pick the one that gives me the best result, right? So the average is there to make sure that you have a reasonable measure for the receivable. Now, this will only tell you how many times, we'll put some numbers in here in a second. It only tells you how many times per year you do this. So what if I told you, oh, you know what, I collect receivables on average 20 times per year? Not very useful. We like to convert that into days, and we have something called the collection interval, or days sales outstanding. And if we take 365 and we divide that by the receivable turnover ratio, we get the collection interval. Now it tells me how many days it's going to take me to go from sale to collection, from receivable to collection. All right. So that, we're going to put some numbers in there in a second and then do some computation. Inventory turnover. How many times per year do you go from full stock to stock out? On on average. How long does it take you to sell out your inventory? That ratio is the cost of goods sold divided by average inventory. So the average inventory, again, would be beginning plus ending divided by 2. Cost of goods sold, the flow variable, you convert inventory to a flow by taking the average. Again, it's more useful when we convert it to number of days. I want to know how many days on average I'm holding that inventory, and I'll do that by taking 365 and divide it by the turnover ratio. And that's known as the holding interval, the holding interval. Now, that holding interval is going to be useful because now it's going to tell me, well, wait a minute, if I got to wait 30 days to collect my receivables, if I need 80 days to sell inventory, I got to wait for my cash for 110 days. The next question is, how long do my suppliers give me on average? And then we can use the accounts payable turnover ratio. And this is a measure of how many times per year you go from maximum receivable payable balance to full payment. Now, the problem is the ratio is calculated as production or purchases divided by average accounts payable. And generally, you don't see that directly in the financial statements. I never, you can find it, you can derive it, but you really don't see purchases or production highlighted in a statement. But you notice the statement I'm making here, if it's assumed that beginning and ending inventory are similar, and they are, because most companies carry inventory at about the same level every year. So just take a department store, for example. The department store will have its lowest levels of inventory at the end of the year, and so is their beginning inventory at its lowest levels, and then they build up and then sell out, and it's a cycle. So if you look at beginning inventory, let's take purchases, and we'll call that the goods available, minus the ending inventory. That gives you the cost of goods sold. Let's say you buy 1,000, you start with 100, your goods available is 11, and if your ending inventory happens to be the same or similar, cost of goods sold is going to be a good way to proxy or estimate purchases or production. So for our purposes, for our questions or exams, we're going to use the following. We're going to say that accounts payable turnover is cost of goods sold divided by average accounts payable balance. So we're going to use cost of goods sold to proxy for purchases or production. And then again, the payment interval is probably the most important because that's going to tell us the number of days my suppliers give me to pay back. That's the average credit period. So it's 365 divided by the accounts payable turnover ratio. Now, from this, we can get the operating cycle. And what I have is bracketed here, negative, means I'm waiting for cash. That's all it takes to do. So let's now put some numbers in. Let's do inventory turnover first. If you go back to the financials, cost of goods sold, and these are on pages 9 and 10. Cost of goods sold is on page 10, and it is $1,700. Inventory. On page 9, beginning inventory is $300. Ending inventory is $350. Average inventory is $325. You take beginning plus ending. It's $650 divided by 2 is $325. So that tells me that I turn inventory over 5.2 times per year. So that means this company buys inventory and sells it out a little over 5 times a year. Not that informative, but if I take 365 and divide it by that turnover ratio, it tells me it's taking 70 days to sell that inventory. Now, I don't know if that's good or bad. It may be better than the industry average. It may be an improvement in the trend. but it's gonna take me 70 days. Now, I've gotta wait 70 days before I sell the inventory. Once I sell it, how long does it take me to collect it? Well, I'm gonna look at accounts receivable turnover. If I now go into the income statement again on page 10, 3,000 for sales, beginning and ending receivables on page 9. So I've got 200 as my ending receivables, beginning receivables are 100, divide that by 2, so that's 300 divided by 2, so average receivables are 150, and the turnover is 20 times per year. Again, I will sell and collect 20 times on average. But number of days, 365 divided by the turnover is 18. So I'm collecting in 18 days. That's pretty good. How does that happen? What's the average credit term? What do you normally get to pay back a 30? 30. How do you get it to 18? I don't remember anything from each one. Discounts, right. You get cash discounts for early payment. So maybe this company's using cash discounts and they're getting their customers to pay early. So now, we go down to the bottom, what I've got is, I've got to wait 88 days for cash. That's how long it's taken me to wait. I got to hold inventory for 70 days on average, and it's going to take me 18 days to collect. And all this is going to tie into the classifications of current versus non-current. It also will tie into other things we're going to do with respect to bad debt and inventory. For example, is this ratio inventory turnover, is that biased or affected at all by the inventory methods I use? Yeah. If I use LIFO, cost of goods sold is higher, inventory is lower, it gets biased downward. So that's why you've got to go to the summary of accounting policies, understand the measurement system to understand those results.
Also, do you have to take into consideration the safety stock?
Yeah, if they have any, sure, yeah, as well. Yeah. And that's going to be in, well, yeah, that would be for sellout or for missed opportunity in terms of logistics, but it would be in that inventory as well. So what we're going to do is, I'm not going to just stop with these ratios today. We're going to, build on this, especially for cash flow. All right, one more to go, and that is the accounts payable turnover. We're going to use cost of goods sold as a proxy, so that's 1,700. Payables back on page 9. 500 beginning, 400 ending. Divide that by 2. That's 9 divided by 2. That's 450, and 3.8 times. So I have a payable balance. I pay it off about 3.8 times per year. But if I divide that to get my payment interval, if I divide that into 365, it's 96 days. That's a lot. How do you get that? You ever know? How do you get 96 days to pay back? Yeah. Well, it's a relationship, and it's also, more importantly, it's an industry. For example, one of my clients was in building products. They were making construction material. You got to stop construction at certain times in this part of the country, right? And the north, you can't build outside. You've got to halt production. So the suppliers would do the following. They would tell the building companies or the contractors, look, if you buy the inventory in the winter, hold it, you don't have to pay me for 3 months until you start building again. Why do I do that? It takes the inventory off my shelves. It keeps my factories running constantly. It avoids me laying off people. Because don't forget, if I had to shut the factory down, I have to lay people off in the winter. It increases my unemployment payments, my benefits. The state will charge me for more if I have more unemployment benefits drawn against their company. So That's known as winter dating of receivables. The same thing happens in agriculture. Companies that deal with fertilizer, companies that deal with agricultural products, there are certain growing seasons, and they would give you that extended period. So I just wanted to point out, and I slanted the numbers to ask those questions. But now I have a benefit from this, and that is I now know that if I have to wait 88 days to get my money, but if you're giving me 96 days to pay, I've got 8 days of excess cash. So the conclusion would be there is no need for short-term financing because the credit interval exceeds the operating cycle time. So if I was analyzing this company from the standpoint, that's why your classifications are so important. That's why the methods that you use as accountants are so critical, because people are making decisions based on this information. So again, this would tell me I don't need any short-term financing. The liquidity is positive in this case, and what would I do with that money? I've got 8 days float. Short-term investment, cash equivalents maybe, right? You buy something that you know you're not holding for long-term interest. And that's what, going back to the cash equivalent, the idea of a cash equivalent, you buy it with less than 90 days to maturity because you know you're going to sell it right away. So you get a treasury bill, you get like 4% for a couple of weeks, or whatever it is, 8 days, a week, better than holding it idle, right? And you might even use this to pay off some other debt. So this is an example of using classifications, examples of using the balance sheet to make those types of decisions. All right, so that's module number 1. So we know what happens on Thursday, right?